Welcome to another podcast of the Riffle series. The Riffle, a podcast series brought to you by 10 Leaves. Usually when you look at a corporate balance sheet, you really just expect it to be a pure reflection of, like, cold, hard math.
Right, yeah. Dollars and cents.
Exactly. Dollars and cents. Assets and liabilities. You certainly don't expect to have to, look out the window at the weather forecast to figure out if the math is actually right.
No, historically you wouldn't at all. I mean, those two worlds, meteorology and financial accounting, they operated in completely isolated silos. Financial risk was, it always treated as binary. The capital is either sitting in the reserve or it isn't. The weather was basically a problem for scientists, not accountants.
Right. But when you step into the reality of modern financial regulation, that separation is, well, it's completely evaporating. The weather forecast and really the long-term climate reality is suddenly becoming just as critical to the balance sheet as, say, a central bank's interest rate. And that is exactly what we are unpacking today.
It is, yeah.
We are looking at a massive, sweeping regulatory shift that just took place. So on April 27, 2026, the Financial Services Regulatory Authority of the Abu Dhabi Global Market, the ADGM, implemented just a colossal array of amendments across, I think, 7 different regulatory rule books.
7, yes. And it is an incredibly comprehensive overhaul. I mean, we are examining foundational changes to the general rules, the prudential rules, the conduct of business rules, and the market infrastructure rules. They have effectively opened up the entire regulatory framework and just completely rewired the central nervous system of the financial sector.
Okay, so let's unpack this. The mission for our deep dive today is to figure out how ADGM is fundamentally changing the rules of the game for insurance and financial risk.
Right.
Because this isn't just about regulatory red tape.
Right, no, not right.
And it isn't just a localized update. This is really a blueprint for how global financial centers are adapting to modern existential threats. It's like looking under the hood of a car while the engine is being completely rebuilt, but the car is still running down the highway.
That's a great way to put it. We are talking about the hard financial reality of climate change, totally new global accounting standards, and really the evolution of consumer protection.
Yeah.
And, it is vital to establish right at the top why this matters to you, the listener, because insurance is, well, it's the underlying shock absorber of the entire global economy.
Right. Without it, ships don't leave port.
Exactly. Skyscrapers don't get built, mortgages don't get underwritten. So whether you are an institutional investor who's scrutinizing corporate valuations or a business owner managing supply chain risk, or simply someone paying a monthly premium for life or property insurance, these changes dictate how your money is protected.
Yeah.
When a major regulator changes how that macroeconomic shock absorber is built, it alters the ride for every single person in the car.
Which brings us to, I think, the most jarring part of these amendments. It's not a standard financial metric. If you look at the general rulebook, the glossary, and the prudential rules, they all weave in a brand new mandate concerning the climate.
Yes. The new rules mandate that all authorized persons and recognized bodies must systematically identify and manage what the regulator terms, quote, climate-related financial risk.
Right.
And the specific condition here is materiality. They are legally obligated to act if this risk is material to their business model, their long-term financial position, or just their broader regulatory obligations.
And this isn't just asking companies to, publish a glossy annual environmental report with nice pictures of trees.
Right. No greenwashing here.
It is integrated directly into the internal risk assessment process, the IRIP.
Right.
They are dropping climate change right alongside traditional hardcore financial metrics like credit risk and market risk.
Yeah. And to eliminate any ambiguity about what firms are supposed to be measuring, the glossary rulebook explicitly defines climate-related financial risk by breaking it down into 3 highly specific buckets.
Okay, let's go through those.
First, we have physical risk. This represents the probability of direct economic and financial losses resulting from actual climate and weather-related events, or even the long-term chronic impacts of a shifting climate.
So we are talking about literal floodwaters damaging a manufacturing hub.
Exactly. Or, extreme prolonged heat waves devastating agricultural yields that a bank happens to have financed.
Okay, physical risk makes intuitive sense to me. Floods, fires, physical damage. But then the rule book lists liability risk. How does a weather event become a liability risk for a financial institution?
Well, consider the legal chain of events. Liability risk encompasses the threat of direct legal actions or compensatory claims against financial firms or the companies they back regarding climate issues.
Wait, like lawsuits?
Yes, precisely. Imagine a scenario where a massive fossil fuel corporation is successfully sued by a coastal municipality for the rising costs of building seawalls.
Oh, wow. Okay.
If an ADGM-regulated insurance firm is underwriting that corporation's liability policies, or a bank is heavily financing their operations, that legal judgment instantly becomes a direct financial loss for the financial institution. The regulator is forcing them to look ahead and account for that legal vector today.
Wow. Okay, so physical destruction and the lawsuits that inevitably follow. That leaves the third bucket, which is transition risk. The rulebook defines this as the risk of losses related to adjusting to a lower carbon economy. It mentions shifts in climate policy, new technological advancements, or changes in, quote, market and social sentiments.
Right.
I have to push back here a little bit. Is transition risk essentially the blockbuster ignoring the streaming revolution scenario, but for carbon?
That is a remarkably accurate comparison, actually. Yes.
But more importantly, how does a financial firm actually measure something as nebulous as a change in social sentiment and then translate that into a potential balance sheet loss?
And that is the exact challenge the ADGM is addressing here, and it represents just a profound shift in regulatory philosophy. This framework takes climate change completely out of the environmental, social, and governance, or ESG, marketing department.
Which is usually very narrative-driven.
Exactly. It takes it out of that and forces it into objective balance sheet reality. Now, the regulator acknowledges that pristine quantitative mathematical models for something like social sentiment or reputational damage, well, they might not fully exist yet.
Right.
So because of that, if firms lack hard historical numbers, the rules explicitly permit them to use qualitative disclosures and descriptive analysis.
So they can't just throw their hands up and say, hey, vibe shifts are way too hard to calculate, so we just aren't going to report them.
Not anymore, no. They must document a clear methodology and demonstrate that their approach to managing and quantifying this risk is actively improving over time as data and modeling catch up.
That makes sense.
And even more crucially, they must assign definitive oversight to the board of directors and senior management. The individuals at the absolute top of the corporate hierarchy are now legally on the hook for monitoring these transmission channels.
Oh.
If they ignore a shift in technology that renders their core investments obsolete, they faced direct regulatory censure.
So to be clear, the regulator is basically saying, look, we aren't taking a political stance on whether you should care about the environment. We care about whether your institution will go bankrupt if a new global carbon tax is introduced next year, or if the properties you insure are physically underwater in a decade.
Precisely. It is a strictly prudential approach to structural reality.
Now, if we are suddenly forcing banks and insurers to quantify these unprecedented risks, like long-term transition risk, the old math just doesn't work anymore, does it?
No, it really doesn't.
The fundamental equations of how an insurance company proves its financial health have to change to accommodate this new reality.
And that necessity brings us directly into the massive modernization of the insurance engine itself, specifically within the captive insurance business rulebook and the prudential insurance rulebook. ADGM is operationalizing a new, globally recognized accounting standard known as IFRS 17.
Okay, I'm going to stop you right there because I'm not an accountant. How does IFRS 17 actually change the nuts and bolts of the math? Like, how do they calculate the value of these long-term liabilities now?
Sure. So under IFRS 17, insurers are required to measure the net present value of expected future payments and expected future receipts. To determine the present value of a payout that might not happen for, say, 20 years, you have to apply a discount rate to those future cash flows.
Okay, I'm following.
And here is where the regulator really tightens the leash. ADGM mandates highly specific discount rates. For calculating that net present value, an insurer must use the gross redemption yield of a portfolio of AAA-rated sovereign risk securities that have a similar expected payment profile to the liability being measured.
Let me make sure I'm following here. Before we go any further, what exactly is a gross redemption yield, and why does it have to be from AAA-rated sovereign securities? Why couldn't an insurer just use the yield of whatever corporate bonds they happen to hold in their own investment portfolio?
Good question. The gross redemption yield is essentially the total anticipated return on a bond if you hold it all the way to its maturity date.
Okay.
The reason the ADGM demands the use of AAA-rated sovereign securities like top-tier government bonds is because they want a pure reflection of the time value of money, stripped of virtually all credit risk. A AAA sovereign bond is, practically speaking, the safest baseline asset in existence.
Right.
If an insurer were allowed to use the yield from their own riskier corporate bond investments to discount their future liabilities, well, a higher yield on those risky bonds would mathematically make their future liabilities look much smaller on today's balance sheet.
Ah, I see. So the insurer would actually have an incentive to take on riskier investments just to make their current financial obligations look lighter on paper. And the regulator is entirely removing that temptation.
The regulator is demanding a strict, standardized, and highly conservative baseline for everyone. No more rosy assumptions.
Wow. Speaking of cleaning up the operational side, I noticed there's a significant change regarding Class 1 captive insurers. The new rules state they are no longer required to prepare quarterly regulatory returns unless the regulator specifically requests them in writing.
Yes.
First off, what exactly is a captive insurer, and why are they getting a break on their paperwork?
So a captive insurer is a specialized type of insurance company that is wholly owned and controlled by the very people it insures. Its primary purpose is to insure the risks of its parent company.
Okay.
Imagine a massive global shipping conglomerate deciding that standard market insurance for their fleet is just way too expensive. So they create their own fully funded subsidiary insurance company just to insure their own ships. That is a captive insurer.
So because they're essentially just insuring themselves, a failure wouldn't necessarily rip through the broader public market.
Exactly. The risk is completely internalized. Therefore, reducing their mandatory quarterly reporting is just a smart reduction in administrative burden for entities that pose a lower systemic risk to the general public. However, parallel to that, the broader reporting infrastructure is being aggressively digitized. Submissions across the board are migrating to the Electronic Prudential Reporting System, the EPRS.
Though I love this highly specific detail in the rules. Despite moving to a digital portal, firms still have to retain an original, signed hard copy of the statement by directors for at least 6 years.
Yes, I noticed that too.
Even with cutting-edge electronic filing, the regulator wants physical ink on paper, proving that the leadership team signed off on the math.
Accountability requires a permanent trail. And speaking of modernizing risk, we also see the explicit codification of cyber risk in these rules. Insurers must now formally develop systems to monitor and mitigate cyber risk with the exact same rigor they apply to traditional underwriting risk, reserving risk, and liquidity risk.
Which is completely necessary today.
Absolutely.
But here's where it gets really interesting to me. As I was going through the Prudential Rulebook, I found these incredibly strict rules prohibiting a practice called lapse support. The text states that an insurer cannot make allowances for future lapses or surrenders of a contract if doing so would decrease their liability. Explain what lapse support is, because it sounds like they're using customer cancellations as a financial strategy.
They absolutely were. Consider the historical context of how insurers viewed consumer behavior. In the past, an actuary might look at decades of historical data and notice that, reliably, 10% of customers cancel their long-term life insurance policies in year 5.
Okay.
If you assume those cancellations will happen, you can legally reduce your reserve liabilities right now. You don't have to hold as much cash today because you are betting those people will drop out and you won't ever have to pay their death benefit.
Let me make sure I have the math right. If I owe $1 million in potential payouts down the line, but I assume 10% of my clients will just stop paying their premiums and cancel, I can suddenly tell the regulator I only need to reserve enough to cover $900,000.
That's right.
So I just created $100,000 of breathing room out of thin air.
Yes. The mechanism at work historically allowed customer attrition to act as a hidden asset. But the danger there is extreme. What happens if a severe global recession or a pandemic hits?
Right.
Suddenly, the public realizes how valuable that safety net is, and nobody cancels their policy. The insurer is instantly left massively under-reserved and completely unable to pay the claims. By banning lapse support, ADGM is explicitly stating that you cannot use the hope of consumer attrition to make your balance sheet look healthier than it actually is.
They have to evaluate policies assuming everyone will keep them until the bitter end. It forces them to plan for the absolute worst-case scenario.
Yes, precisely.
Now, if regulators are forcing primary insurers to assume those worst-case scenarios, that pressure travels upstream. A primary insurer can't hold all that concentrated risk on their own balance sheet without going under, so they have to offload it. Which brings us to the safety net of the safety net reinsurance.
Yes, reinsurance is the ultimate backstop. And the ADGM has introduced intensely stringent requirements in the Prudential Rulebook for how an insurer manages its reinsurance strategy. An insurer cannot simply pass the risk to a third party, wipe their hands clean, and close their eyes.
Right. They must rigorously assess the actual credit standing of their reinsurance counterparties. They can't just take the reinsurer's word for it. The rules say they have to utilize external ratings, seek objective advice from brokers, and continuously monitor key performance indicators in the reinsurer's published reports.
It goes much deeper than just running a routine credit check, too. Primary insurers are now required to actively identify aggregations of risk exposure. They must select maximum probable loss factors, and they are legally mandated to plan for realistic disaster scenarios.
So they had to sit down and run literal catastrophic simulations, like, what if a Category 5 hurricane hits this specific coastal city where we hold thousands of property policies? And what if our primary reinsurer also happens to heavily back other companies in that exact same city?
That is the precise vulnerability the regulator is targeting. Crucially, insurers must actively avoid concentration risk.
Yeah.
Because if an insurer relies entirely on one massive global reinsurer, they might feel completely protected. But if an unprecedented compounding disaster occurs, say a simultaneous global pandemic and a massive climate event, and that single reinsurer collapses under the weight, the primary insurer is left completely exposed. The theoretical diversification benefits are entirely destroyed.
We can think of it like a massive game of financial Jenga. If the primary insurer is the block at the bottom and they pass the risk up to a reinsurer block above them, the ADGM is ensuring that the higher block isn't structurally flawed. The stability of the whole tower rests on every block being solid.
That's a perfect analogy.
But I want to introduce another layer here. The rules mention something called an authorized ISPV, an insurance special purpose vehicle. How does an ISPV fit into this risk structure? What is it?
ISPVs are fascinating financial mechanisms. They are standalone, specialized entities created for a very singular reinsurance purpose. Often, they are designed to allow capital market investors like hedge funds or pension funds to directly take on specific insurance risks by purchasing catastrophe bonds.
Okay.
If the catastrophe doesn't happen, the investors make a healthy return. If it does happen, their invested capital is used to pay the insurance claims.
Okay, let's use a different metaphor here to understand how this protects the system. Think of an ISPV like the watertight bulkheads on a military submarine.
Oh, I like that.
If the submarine hits a reef so the catastrophe happens, that specific compartment floods. But the massive steel doors seal shut. The investors inside that specific compartment lose their money to pay the claims, but the rest of the submarine, meaning the primary insurer and all of its everyday policyholders, stays perfectly afloat because the water can't spread. Does the ADGM enforce that seal?
They do. The ADGM strictly enforces the integrity of those bulkheads. The rules mandate severe ring fencing around ISPVs. First, an ISPV's aggregate maximum liability can never, at any time, exceed the total amount of its assets. It cannot owe more than it possesses.
That makes sense.
Furthermore, any debt providers or financing arrangements are fully subordinated to the claims of the reinsurance creditors. And the ultimate seal on that bulkhead, the investors in the ISPV have zero recourse to the ceding primary insurer if they suffer a total economic loss.
Meaning, if the catastrophe triggers and the investors lose their entire principal, they cannot turn around, hire lawyers, and sue the primary insurer to get their money back. It is a completely sealed ecosystem of risk.
The risk is entirely quarantined. It protects the stability of the primary insurer and, by extension, the financial security of the everyday policyholders relying on them.
Which is the perfect place to pivot our focus. We have been discussing massive systemic shifts, watertight bulkheads, climate metrics, global accounting standards.
Yeah.
But how does this immense corporate risk shifting actually trickle down to the person listening right now? The individual who's just trying to secure a life insurance policy for their family or property insurance for their home.
Right.
That brings us to the Conduct of Business Rulebook, or COBS, which seems to completely rewire the interaction between the financial giant and the consumer.
It does. The COBS framework is where all of this structural theory meets the reality of consumer protection. ADGM has constructed a remarkably robust shield beginning at the very origin point of the product life cycle, which is product development.
Right. An insurer can no longer just invent a highly complex, confusing financial product and throw it at the wall to see who buys it.
No, absolutely not. They must undertake serious documented due diligence to understand if their target client segment has the financial literacy to even comprehend the product. They also have to explicitly identify segments for which the product is definitely not suitable.
They must formally identify their non-target market.
Yes. And the transparency requirements accompanying the sale are rigorous. If a client asks, insurers and their intermediaries are legally obligated to disclose all commissions, fees, and other economic benefits accruing to them from that specific sale.
There's also a fascinating new friction point regarding direct long-term insurance, which includes things like life insurance or complex investment-linked policies. The rule states that if a firm is selling this without providing financial advice, meaning it's an execution-only sale where the client just points and buys the firm, must formally recommend that the retail client seek independent financial advice first.
And the critical part is what happens if the client refuses that recommendation.
Yeah, the firm has to secure a written acknowledgement from the client, explicitly stating they refused independent advice. Furthermore, if an insurance intermediary actually does give advice, and the client insists on buying a policy that goes directly against that professional advice, the firm has to get that specific contrary instruction in writing before they are allowed to proceed with the transaction.
Yes, they do.
Why are they forcing this paperwork? What is the behavioral psychology behind forcing a written refusal?
Well, it acts as a deliberate psychological speed bump. In behavioral economics, creating friction disrupts impulse behavior.
Oh.
By forcing the consumer to literally sign a document acknowledging they are acting against professional advice, or refusing guidance on a highly complex long-term financial commitment, the regulator inserts a moment of forced reflection. It asks the consumer, are you absolutely sure you understand what you're doing?
Right.
This mechanism directly curtails aggressive, high-pressure sales tactics that rely on rushing a confused consumer to the finish line.
And those consumer protections continue well after the policy is purchased, especially regarding claims handling. The rules state firms cannot reject a claim unreasonably. If they reject only a portion of a claim, they are mandated to explain clearly, in writing, exactly why that specific part was denied. And they must guarantee that all claims are handled by competent, completely impartial individuals.
Exactly. If we pull back and view this entire section of the rulebook holistically, it is fundamentally designed to eradicate conflicts of interest at their source. The rules explicitly state that compensation structures things like aggressive sales performance targets, quotas, or massive commission bonuses that do not align with the client's best interests are prohibited.
So to synthesize this, if an insurance broker gets a massive year-end bonus, specifically for pushing a high-risk, high-fee investment policy to a retiree who simply needs basic low-cost coverage, that compensation structure is no longer just bad practice, it is a regulatory violation.
It is illegal under these rules, yes.
So what does this all mean? To me, it establishes a powerful financial do-no-harm principle. The era of burying a predatory, confusing policy in the fine print and legally selling it to anyone with a pulse is ending. The institution practically have to prove the customer genuinely needs the product.
The regulator is broadcasting a very clear message. If an institution's business model relies on exploiting consumer confusion or intentionally misaligning financial incentives, that business model is no longer viable within the Adgm jurisdiction.
Okay, to wrap up this deep dive, let's just summarize the immense scope of the April 27, 2026 overhaul. Adgm didn't just tweak a few capital ratios. They rebuilt the entire financial architecture from the ground up.
They really did.
They transformed climate change from a PR talking point into a hard, board-level financial metric. They modernized the accounting foundation with IFRS 17, demanding incredibly conservative discount rates, stripped of credit risk. They eradicated lapse support, forcing insurers to prepare for worst-case scenarios. They mandated rigorous stress testing and watertight ring fencing for reinsurance to prevent systemic domino effects. And finally, they constructed a titanium shield around consumer rights, product suitability, and claims handling.
It's massive. And for you, the listener, this comprehensive framework ensures that the institutions holding your capital and managing your everyday risks are actively looking far over the horizon. They are no longer allowed to just look at tomorrow's stock prices or next quarter's earnings. They are legally obligated to account for long-term climate shifts, evolving cyber threats, and absolute worst-case disaster scenarios. The entire system is being preemptively engineered for resilience.
It is a massive undertaking, and it changes the math of the future. But I want to leave you, the listener, with a final thought to mull over, building on where we started. With climate risks, Specifically, those physical and liability risks now being quantified with the exact same ruthless mathematical rigor as a traditional credit risk. What happens to the businesses or even entire geographic regions that the financial models deem simply too risky to insure and invest in? If the math now demands extreme prudence, and institutions can no longer hide behind optimistic assumptions, we might very soon see a world where your climate footprint or your zip code's vulnerability to extreme weather fundamentally dictates your ultimate financial survival.